Portfolio Paul is all about diversifying risk when buying a business, but probably not in the way that you're thinking. They do go and buy multiple businesses that each one shoves off a decent net profit, but they're not exactly buying businesses in different business models. In fact, they're usually sticking to just one business model. So today in this buyer series, diving deep into Portfolio Paul, we're going to discuss how do they exactly go about building this portfolio and how do they go about boosting their wealth through acquisitions of online businesses. Let's get into it. Hey everyone, my name is Gregory Elfrink. I am the Director of Marketing here at Empire Flippers, where we help people just like you buy and sell online businesses every single day of the week, whether it's content sites, e-commerce stores, or SaaS businesses, or really anything else that is an online business. So today in our buyer series, we're exploring a buyer persona that is known as Portfolio Paul. Now, Portfolio Paul, he's an interesting cat, but before we dive deeper into him, if you want to know what your buyer persona is, there is going to be a link at the bottom of this description that can take you to our buyer persona quiz. Fill it out, takes you a few minutes, and we'll tell you what buyer persona we think you are at the moment. So go ahead, check that out. It's just a fun quiz, but before you do that, make sure you subscribe to this video, hitting this bell, because if you like this kind of content about buying and selling online businesses, internet marketing, and just general business topics that we try to produce on this channel, then that means a lot to us that you subscribe to us, and it also will notify you every time we do a new video. So let's dive into who Portfolio Paul is. So if you've been following the buyer series, which you can if you look at the playlist of the buyer personas, you probably know about the other buyer personas we have done or that we have talked about. Portfolio Paul is another evolution of a previous buyer persona we've mentioned. So they usually evolve from either a lifestyle Larry, a DIY Dave, or sometimes even a flipper Fred. So it just kind of depends, but usually those three personas are the prototype or the beta before someone becomes a Portfolio Paul. Now, what a Portfolio Paul is, they're a little bit, they're like the next level of entrepreneur in a sense, in that they're usually not a solopreneur anymore. They tend to have a small team that is working with them. And this could be as simple as just a couple VAs, or maybe they have a full-time in-house employee, but usually not too big. They don't have like a massive team or anything by that means. They just have some people that helps them manage their portfolio. In addition to that, they're a little bit more of a refined entrepreneur at this point versus say like a newbie Norm or even a lifestyle Larry, because they have systems and processes in place. They've outlined how to do certain tasks. They have checklists. They're just a lot more system based. So that puts them like one step above of a DIY Dave or a newbie Norm certainly, and a lifestyle Larry because of that. But again, not a massive team here, and sometimes their team is literally just a couple of VAs that are working for them part-time. So anyways, one thing that Portfolio Paul is looking for is not so much scale. They're looking to maintain profit. They want a bunch of different revenue streams coming in from a bunch of different places. They're not necessarily looking to scale anything to the moon. They're really a buy and hold kind of buyer. And so they're looking for really quality businesses, typically, usually businesses without problems, unless they're a flipper Fred and they know how to fix those problems, or a DIY Dave, then they might look for problem businesses. But really what they care most about isn't necessarily getting like the best deal in terms of lowest price. Now, of course, they care about that, but that's usually not the top priority. For them, they're really looking at, okay, I want to make this amount of money every single month, and I don't want to work super hard for it. So that's often where the lifestyle Larry part comes in. Because they have so many different businesses, they never buy businesses that take up a lot of their personal time. So they would be pretty much not interested in a business that takes them 40 hours a week to run, unless that's a business they truly want to scale. If they're buying just for the portfolio, they're looking for more businesses that take, say, 1 hour a week, maybe upwards of 5 hours per week to run, because they have so many different businesses, they cannot dedicate more time to any one asset than that, unless they decide to grow their team, which has other implications in it as well. Another thing a Portfolio Paul here is doing, I mentioned a few times, they're looking to diversify the risk. So if one business goes down, that's okay, because they have a portfolio of other assets that are performing for them at any given time. But that does not mean they're diversifying the risk with multiple business models. This is a common mistake I see people who want to become a Portfolio Paul make, where they think, okay, in order for me to diversify my risk, I'm going to have to buy one content site, one SaaS business, and one FBA business. Does diversify your risk, but it is actually riskier, in my opinion, to do that versus say buying all content sites or all SaaS businesses or all e-commerce stores. And the reason why is because this type of investing is active investing. So you need to know the product that you're buying. You need to know the business you're buying and how to run that business. And it is a very rare person who knows how to do every single online business model under the sun and run it beautifully. It's just, I mean, they exist for sure. And if you're one of them, then hey, hats off to you. But most people are not that. So I would not recommend you doing this. I've seen this happen before where someone has spent literally hundreds of thousands of dollars on buying so many different business models, and they only knew one business model somewhat well. So the other ones all suffered, and they never even worked on the other business models because they just didn't know what to do with it, right? And there's just too many moving parts if you do it that way. And you don't get to leverage all the systemization and the SOPs and the team you've created by doing this. Because often business models run so differently, you need entirely different processes for that different business model. So the way Portfolio Paul diversifies is not by buying different business models. They diversify by buying different businesses within the same business model typically. So let's take a quick look at Portfolio Paul's business model here. So, and by business model, I mean his business model for buying businesses. Now, this model makes a lot of sense. If you look at the cash on cash return, which is a very valuable investor metric to see how much interest you're basically earning on your money with the money that you spent, Portfolio Paul is getting a great deal here on his cash. Even if you compare it with something like real estate, with like using leverage, Portfolio Paul will often outperform that real estate investor who gets to use leverage, which, as you know, if you're a buyer in our space, doesn't really exist. Like, it's very rare that someone will give you like, here's a loan to go buy an Amazon affiliate site. It's just not very common. So let's take a quick breakdown of how does this cash on cash return actually look like for someone that is a Portfolio Paul. So let's look at an SFH, a single family home. SFH, I'm just saying, I know my real estate investor jargon, but let's look at an SFH, a $100,000 home. This is usually the most common type of investment people make in real estate. And let's say, you know, it is a relatively good deal, not like a crazy good deal, but it is still a good deal. So that $100,000 home meets what real estate investors call the 1% rule. The 1% rule, not really a rule, is more of a general guideline that your rent should equal 1% of the sales price of the home. So in a $100,000 SFH example, that rent, monthly rent would be $1,000 per month. Now there's a second rule that real estate investors layer on top of that, which is the 50% rule. Again, not really a rule, it's just a guideline, but that states that out of your monthly rent, 50% of it will go to expenses. So you can just say, all right, 50% of that is already gone. It's eaten up by other costs, say like the mortgage, taxes, you know, whatever. It's just gone. So now we're down to $500 per month of what you're making from this single family home if everything is working perfectly. And so this is still a pretty good deal, right? A lot of real estate investors are glad to make $100 a month off of some of their real estate. So $500 a month annually, that's $6,000 of profit that you're getting from that investment. And since it's real estate, you probably only actually put $20,000 down on the property because you can get a loan for 20% down. So $100,000, you put $20,000 down, you're making $6,000 per month. $6,000 divided by that $20,000 gets you a cash on cash return of 30%. And a cash on cash return of 30%, that is excellent, right? Who would not want to make 30% on their money, right? That is a fantastic return. So this real estate deal actually might be a super good deal because usually they don't get that high. A lot of real estate deals are pretty happy at between 10 to 17% cash on cash return. And the cash on cash return is based off the money you spent, not the value of the asset. So yes, the single family home is worth $100,000, but you only spent $20,000 because you used leverage. So your cash on cash return uses that $20,000 because that's actual money out of your pocket and the actual net profit, which is again, that $6,000 annual net profit that you're earning. So now let's take this same $100,000 and compare it with an online business that Portfolio Paul might want to buy, a $100,000 business that they buy. So Portfolio Paul, he goes and buys a $100,000 online business, whether it's an affiliate site, e-commerce store, whatever it might be. And that $100,000 business, it's pretty reasonable to say it's making about $3,500 net profit per month. And that is actual net profit. So we already because online businesses are sold based off profit, not off revenue, this is the actual true net profit that Portfolio Paul gets to keep every single month, unless they decide to, scale the business or fix a problem or expand or something like that. If they're just maintaining the business, it should be cash flowing about $3,500 per month. $3,500 per month at the end of the year, that's $42,000 of profit in their pocket for that same $100,000. Now, they did not get to use leverage, so they actually spent a full $100,000, 5 times of the investment that it would cost to usually invest in a single family home if we're comparing apples to apples here. So still, that is fantastic. Who would not want to spend $100,000 and make $42,000 a year, right? Of course, there's tons of risk involved with buying an online business. It is a very volatile space, so keep that in mind, but this is just a hypothetical comparing the two. So you take that cash flow that Portfolio Paul is getting from his new business at the end of the year, $42,000 divided by the $100,000 that he spent, and you're getting a cash on cash return of 42%. That is huge. That's 12% higher than the great real estate deal that I just talked about earlier. And remember, most investors are happy with between 10 to 18% on their real estate investments, on their cash on cash return. So this is huge. Even if your business failed by a dramatic amount, you would still be outpacing that $100,000 single family home investment. Of course, you can't use leverage in online businesses. You can, it does exist, but it's just very difficult to get, and often it's very expensive debt. So we don't usually ever recommend you take on any kind of debt to finance an online business. There are scenarios where that makes a lot of sense, but usually the areas where that makes sense is if you're doing something like getting money from a family office or from a private equity firm, stuff like that. It could make more sense, but usually by then you're playing in the 7-figure range, not the $100,000 range, because usually those people are not going to look at anything that's smaller than say like a $2-3 million business, right? And even then, there's not very many of them who will look at a business even that small. So when you're doing this kind of investment strategy, yes, you are spending a lot more capital upfront than if you bought that single family home, because you most likely will not have any tools of leverage. And it is far riskier, like I said, because one, your capital exposure is huge, but with the risk comes the reward, and a 42% cash on cash return is unheard of, to be honest. It's not very common. It's not something that happens every single day of the week with other types of investment vehicles. So if you get a 30% cash on cash return in say real estate or stocks, that is gigantic, right? That is huge. Versus a online business of 42%, that's just a business selling at a normal multiple on our marketplace. It's about a 30x or something around there. So you can make a very aggressive ROI as a Portfolio Paul just by buying these businesses. And if you know how to run them and maintain them, and you're buying good quality businesses that really don't take that much time to run or maintain, then you're in a good place to start building out these assets in your portfolio. So now that I described the business model, let's go into some of the mistakes that Portfolio Paul makes. So then again, the number one risk Portfolio Pauls make, and usually this is the brand new Portfolio Paul because the more experienced ones have usually learned this lesson the hard way, is they decide to diversify by buying different business models. And I've already described why that's a bad deal. For most people, not everyone, so you might be the wonder kind that's really, really good at running everything. I don't know, but for most people, this is not going to be a good move for them. It is much better for you to just stick to content sites, stick to Amazon FBA, or whatever your skill set really is. You can be an amazing FBA seller, but you might be a terrible SEO. And when you buy a content site whose main traffic is SEO, you might put yourself at a level of risk that I wouldn't recommend. So keep that in mind. You want to just diversify by niche, not by business model. So again, if you're an Amazon FBA seller and say you buy a business that is the garlic press, the best FBA product example in the world, then maybe you diversify into another niche, say like dog bowls, something like that. Same exact concept. They're both Amazon FBA businesses. They're both playing Amazon's ecosystem, and you get to leverage all the systems and SOPs you have built, but they are diversified by risk. If garlic pressers go out of style, then hey, you still got the dog bowls, right? People love pets. The dogs will probably be around forever, drinking and eating out of bowls, right? So that is how you diversify your risk, is by niche, not by business model. Another way you can diversify your risk is by different methods of building the business. So You might, if you're a content site buyer, you might build something. You might build a content site using, say, private blog network links, PBN links on one site, which are inherently more risky than, say, true white hat outreach links. But those PBN links can grow a website much faster because PBN links are usually much more powerful than a white hat link. And if you do it right, it can be pretty safe. It can be pretty safe to build a site with PBNs if you know what you're doing. But you might not want to do that with all of your websites. You might want to do that with a few of your websites that can grow that cash on cash return even faster and build out some of the other brands that might have more long-term sustainability in terms of like they can really scale into a bigger brand down the road with just white hat links. So that is your goal, is you diversify by risk, or I'm sorry, you diversify by niche, not by business model, and you diversify by your method of building. Now, you don't have to do that last part. You don't have to diversify by your method of building. You can go either way. I don't recommend that you have to do that, but that is another way you can diversify your risk by just building up different systems for the businesses while still leveraging systems you already know about. Another risk for Portfolio Paul that they run into is if you buy so many businesses and you just keep your team very low level in terms of just having like 1 or 2 part-time workers and you have no real like manager or thought leader within your business, then you run into the risk that you just don't have the time or the willpower to manage the business you bought. You might be thinking like, if I spent $100,000 on a business, I'm gonna make time to manage that business. Well, we all are optimists until we have to actually do the work, right? So that is another thing. Like, you need to make sure that you are actively managing this, because again, just because you're building a portfolio that kicks off good net profit every single month with businesses that are very easy to maintain, that doesn't mean you don't have to maintain it. It's active investing. It's not passive investing. So you need to be actively involved in your business. So if you are growing this big portfolio, what I would recommend you do to avoid this mistake is start growing your team. Take less profit from the business every single month by training someone up to start managing these businesses for you. And there's a bunch of different ways you can do it. It's way out of the scope of this video, but that is something you should really consider, is start building a real in-house team that can start running your portfolio for you. And that way, once you do this a few times, once you have a few redundancies, like a few operators within your team that are managing a few of your brands, you can become more of a focused deal maker. And this allows you to add to your portfolio at an ever faster clip, because now you have 2 people. Maybe you can manage, say, 30 sites. I've seen one person manage as much as 50 sites at once, which is absolutely crazy. But let's say you can manage 30 sites yourself. You hire 2 people. Each one of them can handle 10 sites because they're just not as good as you yet, right? They're still learning the ropes, all that kind of stuff, but they can handle 10. Great. Now you're managing 10, you have a bunch of free time yourself to go out and acquire 20 more. And this is the way a Portfolio Paul grows. They grow by adding to their team because they only have a limited finite amount of time. And since they're not looking to scale a business, it's usually a little bit easier to hire people to just manage the business because there's usually a very routine task that you're doing day in and day out. Now, Portfolio Paul could grow a business. In fact, this is another thing I recommend, and it's a mistake I see Portfolio Pauls make. They decide, look, I'm going to buy like 20, 30 businesses over a period of a few years, and I'm just going to maintain them. That's great, but you're missing out on an opportunity. You should look at your portfolio every now and then, maybe it's once a quarter or something like that, where you see, okay, which has the highest growth opportunities and how can I grow that business? Because you will, as you keep acquiring these businesses, you will stumble upon these golden nugget businesses that are kind of like diamonds in the rough that you just spent a little bit more time and a little bit more money on, maybe to the point where it's not even profitable for a month or 2 as you're reinvesting heavily into that specific brand, that you can grow it dramatically. Another thing with a Portfolio Paul that another strategy you can do as a Portfolio Paul is you can kind of raise your own seed money from your portfolio. And the way you do it is you just sell off a bit of your portfolio. So remember earlier that I talked about the mistake that sometimes Portfolio Pauls, they build too big of a portfolio where they're not actively managing it anymore. Take a good hard look at your portfolio and say, hey, there's a website I haven't touched in months. I wonder how it's doing. It's still paying me. I haven't actually looked at it in a while. That could be a really good sign that, hey, you should sell this website. I mean, if you own the website for, say, 12 months and the profits have not gone down, it's very unlikely that you're going to sell that business for less than what you bought it for, because you have a whole year's worth of data added onto it. If anything, you're going to sell it for at least what you bought it for, notwithstanding other circumstances, but most likely you'll sell it for more. So even if you didn't improve the net profit of the business dramatically over, say, a 12, 18-month period, it's still relatively the same, and you bought that business for a 30x, is not terribly unreasonable that you'll sell it for 31 or 32x, get all your seed money plus a little bit more back from selling that business. Plus you got to keep all that profit for that first 12, 18 months, however long you owned it. So those are just some strategies as a portfolio Paul, what you can do. Look to diversify, not through business models, but through niches and ways of building those businesses. Look to expand your team to get people to really hone in and operate and manage your assets so you can become more of a full-time deal hunter. And also look at your portfolio from time to time of which ones you should sell off and get a little bit of a boost to your capital where you can raise your own little seed money, and which ones you should be heavily investing in. Maybe you need to focus to scale the certain business that can just absolutely blow up if you did. And you can sell off all your underperforming parts of your portfolio to build that capital to scale that other business. So that's a really nice advantage of being a portfolio Paul. So what kind of businesses do portfolio Pauls buy? Well, I've already pretty much hinted at most of this list, but you're looking for pristine businesses. You're looking for businesses that don't really have any problems typically, because again, you're not looking to spend a lot of time on these businesses. In fact, the opposite is true. You want to buy businesses that are much more associated with a lifestyle Larry. You just want to buy a lot more of them than lifestyle Larry would probably ever buy, right? So you're looking for businesses that are pristine, usually with no real problems. It's cool if you get the business for a cheap price, but even that shouldn't really be your priority. What you're looking for is something that looks very steady. You don't want to buy a business that's just like going through the roof profitable or declining, towards the basement. You're looking for something that is steady, that has long-term potential, at least between 12 to 18 months long-term potential, hopefully even longer, that will be spitting off this cash flow for you every single month. The other thing you're looking for is things that can be systemized. So this goes back to you being knowledgeable in your business model of choice and you being able to just take this asset, do an onboarding with your checklist of your SOPs, bring it up to par with your other assets, and more or less be able to relax and have your VA or maybe the new person you just hired to manage some of your brands to come in and run the business more or less for you. You still want to be meeting with that person once a week to make sure the business is going good. And those are the kind of businesses you should buy as a portfolio Paul. You're not looking for the craziest great deals. Like honestly, a business that's just producing steady on their P&L is a fantastic buy for a portfolio Paul, because you're a buy and hold buyer at the end of the day. Usually you're not really looking to do all the crazy deal making. You're just looking to build real awesome cash flow. So that is what I recommend for portfolio Paul. Look at those pristine businesses. And my last tip here, I know I harped on it so much about don't buy different business models, but as you get more comfortable with the business models you run, especially if you have someone now on your team that is actively running and managing a lot of your portfolio for you, don't be afraid to expand to other business models. Don't be afraid to make that jump from, say, Amazon affiliate site to Amazon FBA. Yes, you're going to make a lot of mistakes, but those mistakes can be awesome learning experiences for you down the road. And just because you're expanding to a new business model doesn't mean you need to buy a business model that is of the same price or more than your current portfolio. You can start small, right? So you might be upwards of buying $500,000, $600,000 affiliate sites at this point. And when you expand into Amazon FBA, hey, I'm probably going to mess this up. So let's just spend on buying like a 50, 100K Amazon FBA business to start out, get my feet wet, all that kind of stuff. And this is a way where you can start building yourself into another buyer persona, something that I like to call strategic Sally. And we'll be covering who strategic Sally is and why she is the buyer that every seller absolutely loves and why she gets often the best deals, even if she pays the most. So see you guys in that next video. If you enjoyed this content, please go ahead and hit the subscribe bell. You'll be notified every single week when we do launch new videos. I sometimes make mistakes and don't publish, but I do try to publish at least once a week, fairly consistently, on topics of buying and selling online businesses, internet marketing, and business topics in general. So when you do subscribe, you'll be notified every time a new one of those drops. And if you don't mind, I would absolutely love it if you leave a comment down below. Tell me what your thoughts of Portfolio Paul are. Do you feel that you are a Portfolio Paul? Do you want to become a Portfolio Paul? Just tell me your thoughts and I will talk to you later. I look forward to responding to the comments, and I hope everyone out there in internet land is having a fantastic day. Talk to you soon.